Today I wanted to talk about two things. Firstly, yesterday's GDP number and some modelling we released back in April on and how we forecast GDP. And the second thing I'd like to talk about is something that's very important to the acceleration of Australian GDP right now, and that's the iron ore price. Earlier this year, we started showing a model of Australian GDP, and the model was based on employment and hours worked. We have shown this model a couple of times, and what we're attempting to do is something like nowcasting the Australian economy. It's not quite the same as nowcasting because we're not doing it in the quarter, but within a couple of weeks after the end of each quarter, we have a full picture of employment on each of the months of that quarter, and we can put that together and run our model and look at what was happening in terms of hours worked and look what was happening in terms of employment and estimate what GDP was for that quarter. And we did this last time on the 29th of April. And when we did that, we found that in the first quarter, GDP, by model of first quarter GDP, we found that when we looked at hours worked, is actually a really, really large number. There's 1.8 billion hours worked in the March quarter. And that was an increase of 47 million hours for the quarter. And we found when we looked at employment that the number of jobs had increased by 188,800. And we put those two together in our model. And what we said in the piece was when GDP grows, it adds both capital and labour. This means that the increase in GDP will be greater than just the number of jobs. When we construct our model for the Australian GDP for the first quarter, it suggests that GDP in the first quarter rose by 1.8%. In American terms, we would say it would rise by 7.2% annualised, and this high rate of growth is certainly high enough to allow us to achieve our growth rate that we estimate for the full year of 5.25% for full calendar 2021. So yesterday, when the number for the first quarter was published, it came out at exactly the same as our estimate of 1.8%. So in the 3 quarters that we've been running this model, we've been able to estimate GDP correctly to within 1 to 2 basis points. But yesterday was the closest to actually hitting when we actually hit the number. So what in taking this process forward, what we'll do is towards the end of July, we'll get the numbers that will be published in July, which will allow us to estimate GDP for the second quarter based on the full employment picture and the number of hours worked for that quarter. Something that's been enormously important to the recovery of GDP in Australia has been commodity prices and especially the iron ore price. Now, we've had a lot of debate in the last couple of weeks about China trying to put downward pressure on the iron ore price. And in our updated model of the Australian export iron ore price, which is in our quarterly presentation, which is available on the internal-only database next week, we can understand why China's been trying to talk down the price. The first important thing in our model is that Chinese steel production is now at another all-time record high, and this time it's risen to 97.9 million tonnes per month. 97.9 million tonnes per month. In April this year, and that's an all-time record high for China, but that single month's production of steel in China is larger than the maximum level of production in most other countries. It's an enormous level, and that means that there's an enormous level of demand for iron ore. We can see in the data that there's been a slight rise in iron ore stocks at port in China, but the domestic demand is rising faster than the rise in stocks. And so the result of that is that the stocks to consumption ratio, which is what drives our model, has fallen through this year to a level of 4.87 weeks of production. It peaked at about 5.5 at the beginning of the year and has fallen since that time because, as I say, production and demand is rising faster than stocks are. And as that stocks to consumption ratio falls, it tightens the market against China. And so the result of that is when we run our model for the updated price estimate, the price estimate in our model has risen by almost $50 a tonne since the end of last year. And it's risen from under $100 a tonne now to $147.50 a tonne. Now, our model explains 80% of monthly variation of the iron ore price. It's one of the better commodity models we have. And it doesn't just include the fundamentals, it also includes momentum, because this is an incredibly big industry. The Chinese steel industry is overwhelmingly the biggest steel industry in the world. And that was what you would expect from a Marxist-Leninist economy, where there's central command by the Chinese Communist Party, and it fits perfectly well in with Marxist-Leninist theory and is a really big, successful industry. But as they build production as they go through the year, that increasingly puts pressure on stocks, and that drives up the price. Now, currently the price is still $50 a tonne higher than or $44 a tonne higher than our model estimate. But still, our model is rising as we go through the year, not quite as fast as the spot price, but strongly as we go through the year. So I expect that in future months there will be further talk from China attempting to turn down the price. But the problem is that fundamentals are turning it against China and moving the price higher. Now, of course, that's really, really important to the Australian economy because, and it's not just for iron ore prices, because as the total income from exporting iron ore and other commodities rises, that generates more money to generate a larger demand for labour in Australia, which generates a surge in the number of people in jobs and the number of hours worked in the Australian economy. And that will allow us to estimate, we think, that growth in the Australian economy will continue to grow rapidly, and this year will be above 5%, and next year growth will still be above 4%.